Widely attributed to Harold Evansky, the core and satellite approach to portfolio construction claims to offer investors the best of both worlds: the efficiency of low-cost, broad-based indexed market trackers and the ability to outperform by adding actively managed funds, themes and individual stocks to a portfolio. So is this approach really capable of delivering the best of both worlds? Or are investors being duped by smart fund manager marketing teams into a false promise of rainbows and unicorns? Today, we're going to dive deep into core and satellite portfolio construction after this. Hi, I'm Vince Scully, Portfolio Manager at Life Sherpa Invest, and this is Investing. Although the core and satellite approach is widely attributed to Harold Evansky, it actually predates him by more than a decade. For those of you who aren't familiar with Harold, he was a late career changer who became a financial advisor in 1985 after a long career as a civil engineer, because high interest rates forced the closure of his home building business. Harold's now 83 and retired, but he popularised two common but flawed strategies that I see time and time again. Firstly, the core and satellite, the subject of today's podcast, and the two bucket strategies for retirement planning. I'm going to cover the bucket strategy in a future episode, but today we're going to focus on core and satellite. The core and satellite approach, as the name is designed to conjure up, involves building the core of your portfolio with low-cost, broad-based, generally market cap-weighted index funds, usually ETFs today, and supplementing this with a satellite of individual stocks, theme funds, active managers, and other assets such as Bitcoin. And the promise is that you can access the low-cost tax efficiencies of index funds while capturing the upside of active managers, in effect getting the best of both worlds. Now, this theory actually goes back to the work of Fisher Black and Jack Trainer in 1973. Fisher Black, a name that you might recognise, was a University of Chicago economist. He's working there around the same time that Eugene Farmer was developing his efficient market hypothesis. And Fisher collaborated with Myron Scholes to develop the Black-Scholes option pricing model, which has become the bedrock of modern corporate finance. Unfortunately, Fisher died before Scholes and Merton were awarded the Nobel Prize in 1997. The Trainer and Black developed what's become known as the Trainer-Black model. Not very imaginative, these economists. And this was based on Eugene Farmer and William Sharpe's efficient market hypothesis, and particularly Sharpe's capital asset pricing model. And the model was an attempt to try and develop a stock selection model that was based on an investor who believed that most stocks were fairly priced, and that's become sort of fairly core to most portfolio construction activity today, but that this investor had information to predict the abnormal performance of a few. And this abnormal performance he called alpha. And that's a term that we now use to generally refer to above market returns. And this model constructs an optimal portfolio consisting of two parts: passively invested index fund containing all securities in proportion to their market value, something that most modern investors would recognise, and an active portfolio containing the securities for which the investor has made a prediction about alpha. In the active portfolio, the weight of each stock is proportional to the amount of this alpha divided by the variance of the residual risk. In effect, what a modern investor would recognise as volatility. Now, this work was conducted around the time that the concept of an index fund was just being developed. Wells Fargo created the first institutional index fund in 1971, and Vanguard launched its S&P 500 index fund in 1976. So the Trainer-Black model was largely theoretical and couldn't be implemented in practice. But it has since formed the basis for much portfolio construction. And it was certainly part of the core curriculum in my studies in the 80s. But its extension to broader portfolio construction has created some really odd outcomes. And that's really what I want to focus on today. Now, I recall attending conferences in the mid-1990s where the core and satellite term was widely applied to this sort of theory. And certainly I was using it, or being expected to use it, to introduce institutional investors to infrastructure, which in the 1990s was probably considered non-core. That most investors were investing in utilities and telcos, but the broader availability of infrastructure funds as an asset class was just lost in a standard equity allocation. And this concept of core and satellite is now a standard part of the fund management marketing playbook. But Evansky's book, Wealth Management, The Financial Advisor's Guide to Investing and Managing Client Assets, published in 1997, which is now, in its revised version, a core part of the US financial advice curriculum, is certainly responsible for popularising the term. So Evansky's version of Fisher Trainer was that the core of the portfolio was 100% indexed using ETFs and index funds, and this was to represent 80% or more of the portfolio. Now remember, ETFs were a relatively new phenomenon in 1997, with the first launched in Canada in 1990, and the more well-known SPY or S&P 500 ETF in 1993. And Evansky then said that the balance, the remaining 20% or satellites around the core, was where portfolio builders should look to add outperformance or alpha. The satellites are where Evansky says you can take more active bets, use alternative investments, or pursue tactical operations. His key argument was based on tax efficiency, and he argued that it would help maintain discipline and market exposure in the core while still allowing the portfolio manager to pursue opportunities or express investment views without putting the entire portfolio at risk. But this position is fundamentally flawed, and I'm going to work through those flaws very briefly. So there's clearly no performance guarantee, and the main drawback is there is no guarantee that the satellite proportion will perform better than the core. And indeed, evidence shows it typically performs worse. So satellites are more likely to drag on performance than enhance returns. And the entire premise rests on your ability to pick winning active investments, which is notoriously difficult outside fixed interest small companies and emerging markets. It also adds complexity and time requirements. So the satellite portion requires significantly more time for research, trading, and position management than does the core. Managing a core satellite portfolio can be time-consuming and intricate, requiring market analysis, regular monitoring, and adjustments to maintain the desired balance. This complexity can be especially challenging for those without experience in active portfolio management, including many DIY investors. And they're more likely to be influenced by online hype and to make FOMO-fueled investment decisions. It also requires substantial knowledge, and there's risk in selection. So choosing what to invest in the satellite portion requires substantial knowledge and the ability to distinguish between fads, fashions, and genuine trends. And portfolio drift and discipline become problems. So satellites grow too large due to strong performance, the portfolio may become unbalanced. Too many satellites can dilute focus, and a portfolio with too many small positions becomes difficult to manage and track. Overinvesting in satellite investments is a common pitfall that can increase volatility without a commensurate return increase. And that is at the very heart of portfolio management. It's about aligning risk and return. It also raises timing issues that most satellite strategies involve timing decisions, and poor timing can reduce or negate the intended benefits. And this reintroduces the market timing problem that the choice of indexed investing was intended to avoid. It's also likely to be higher cost. Satellite positions generate trading costs, and typically actively managed ETFs carry higher fees. And these costs eat into potential outperformance, the very thing you're seeking from using these satellites. Behavioral risks are also very important here. So this strategy can rapidly become speculation dressed up as strategy. The psychological temptation is to keep expanding the satellite portion or to constantly tinker with it, undermining the discipline that made the core approach sound in the first place. And the fundamental irony here is that core and satellite was designed to combine the best of passive or indexed and active investing. But in practice, it often delivers the drawbacks of both. Index funds' inability to deliver above-market returns in the core, plus the high costs and potential underperformance of active management in the satellites. And one of the most important things to keep in mind here, if it's not good enough for your core, why have it in your portfolio at all? If you genuinely believe an investment is good enough to perform and you have the evidence to support that position, why wouldn't you make it a larger part of your portfolio, i.e. put it in the core? And if you don't have enough confidence in it to make it core, why own it at all? The core satellite approach essentially says, I'm confident enough to allocate money to this, but not confident enough to make it a meaningful position. That's a really uncomfortable middle ground that really doesn't hold up to scrutiny. In reality, the core satellite approach is a hedge against being wrong. You think the satellite you choose might outperform, but you're not sure, so you're going to take a small bet. The bet isn't big enough to blow up your core portfolio, but it's also not big enough to make a material difference unless it massively outperforms. And really, this is just market timing and stock picking with training wheels. You're still doing the thing that's hard to do successfully, just with less money. It does deliver entertainment value, and for many people, this is the reason to adopt this sort of approach. The satellite exists to scratch the investment itch, to have something to tinker with and to feel active, while the core does the actual work. This is honest but expensive entertainment. In many ways, this is the most convincing argument for me. If an investor can get more engaged by having a punt on the side, it will allow the professionals to focus on delivering the core return, which is a clear positive. But it's not an excuse for a professional to indulge in emotional plays. For me, in my personal investing, my TAB account fulfills this entertainment role, and others will take different views. Probably the biggest call on this for professionals is that it's great for marketing to clients. So for financial advisors like Evansky, satellites may exist partly to justify fees and demonstrate active management, even when they know the evidence-based, largely indexed investing in the core is doing the heavy lifting. And this is a game that I'm not prepared to play at LifeSherpa. But it is a message that's been adopted with gusto by fund manager firms' marketing departments. And we'll have a look at the impact of their handiwork in this area after this.
This is Investing is brought to you by LifeSherpa Invest. If you want your money to work harder and not just sit in a savings account earning crumbs, check out LifeSherpa Invest. Choose from 4 risk-based portfolios like Everest 90 with 90% in growth assets. Long-term, low-cost and built for people who are after serious returns. Invest from $5K today at lifesherpainvest.com.au/invest and start climbing.
The biggest part of most satellite plays these days are thematic funds. So that is, the investor forms a view that technology or AI or any other theme, clean energy, healthcare, you name them, they've been used as themes here. And these thematic funds have formed a big part of these investments. And this makes a huge amount of sense in many ways when you look at human behaviour. So these themes seem like a convincing story. And humans have a really strong desire for stories. The themes fulfill our need to feel like we're doing something. So in the 90s, it was fairly well accepted that the internet was going to change the way we lived. So, of course, everyone piled into internet stocks, and 99, 2000, that all fell in a heap. The internet turned out to be a great idea, and much of what we do, in fact, my business would not exist without the internet. But being early is almost as good as being wrong. The second thing is, when it comes to stock selection, most themes involve a concentrated bet. They represent a small slice of the market, and they tend to focus on growth stocks, which have a high price to earnings ratio, which creates significant price risk. So you're paying more for every dollar of today's revenue on the promise that these are going to grow tomorrow. And that leads me to timing. By the time most of these index funds, most of these thematic funds rather, get launched, the trend is usually fairly well advanced and the hype has built, and you may very well have missed the boat. And investor behaviour magnifies our human tendency to buy high and sell low. One of the key lessons that I've learned over the last 40 years is that the signal is not the investment. Now, that might sound a bit obscure, even a little stoic in its terms, but what I mean by that is many of these themes can be identified by market signals. So some sectors deliver outsized returns as investment is made and the hype builds. But all of these trends, from the canals to the railways to the automobile to radio to the internet, and probably no doubt now to AI, all of these sectors, and the AI story is yet to play out, delivered years of underperformance after the initial boom, as other sectors benefited from those developments. So it wasn't the pets.com or the Cisco that benefited from the internet. It was all of these newer companies that didn't exist back in the 90s who've benefited from it. If you look at the names that existed in the late 90s, Microsoft is the clear winner out of that bunch, and Amazon to some extent, although Amazon went through a long period in the wilderness before it recovered. Timing this is extraordinarily difficult to get right, and more importantly, knowing the horse to back is impossible without hindsight. If you go back to the internet era, the obvious bets were Cisco, the plumbing of the internet, and it's still not back to where it was. And the results are very clear. According to Morningstar, the average thematic fund delivered 7% over the past decade, while the average investor in those funds earned 2%, a whopping 5% difference due to the timing of the investor's entry. So these funds develop as the theme builds. As the theme delivers returns, investors pile in, returns fall, and investors end up losing. Researchers at the University of Ohio found that thematic ETFs underperform broad market index by as much as 6% a year over the 5 years following launch, even though the relevant sector performed well prior to launch. And I think the takeaway here is that great ideas and great companies only make great investments at the right price. And if you're buying into a rapidly growing popular theme, you'll likely miss that boat. So you've got to ask yourself when jumping into a theme, what do you know that the market doesn't? And how will you identify the appropriate time to enter and the appropriate time to leave. Those two things are extraordinarily difficult tricks to pull off. So that brings me on to looking at the amount of wealth destroyed by these thematic funds over the period. And the greatest wealth-destroying funds over the decade to 2024 include two technology funds from a single manager. And that manager is Cathie Wood. Now, I love Cathie for entertainment value. Her webinars are extraordinarily engaging, but her ability to call the Tesla price or the Bitcoin price as going to the moon is just hasn't resulted in returns. So the flagship fund, the ARK-K fund, delivered 11.5% since inception in 2014. And that compares to an S&P 500 return of 13.6 over the same period. Now, that's a bit of underperformance, but it's not what you'd call disastrous. But it certainly doesn't live up to the hype. But the real problem here is that the vast bulk of investors piled in after its spectacular run between February 2020, at the beginning of COVID, and February 21, a year later. In that year, it grew 280%. So $1 became $2.80. Today, 5 years later, it trades at its February 22 level. And that destroyed $7.1 billion of investor capital. Cathie's other venture, ARK-G, the Genomic Innovation Fund, whatever that means, destroyed another $4.2 billion of investment money. This one has delivered just shy of 3% a year over the same period and delivered a similar spectacular run in 2021 when it almost quadrupled from its March 2020 low to its high in February 2021. See the trend here? Other trends losing investors vast sums of money include shorting a bull market. So this is investors forming the view that the NASDAQ has run too far. It's overpriced at all-time highs, time to sell. And they've taken a contrarian view by shorting the market. That is, taking out a position where they will benefit when the market goes down. And the big players here, these are US examples, and thankfully Australia has not succumbed too much to this sort of ETF slop. But the ProShares Ultra Pro Short QQQ, or SQQQ, which is a 3 times short position on the NASDAQ. That is, the NASDAQ goes up 1%. You should expect your holding in SQQQ to drop by $3 or 3%, and vice versa. So this is a bet that the NASDAQ will fall. ProShares have a sister fund called SPXU, which is an ultra short on the S&P 500. And then there's a third fund by a different manager called the Direxion Daily S&P 500 Bear 3X Shares ETF. And, given how hard these markets have run, the NASDAQ has delivered 19.5% over the decade, annually over the decade to December 31, 2025. And the S&P is obviously up strongly, not quite as much, but still strongly. And so investors betting against that tsunami of money and performance have toasted another $14.2 billion. So if you add those two together, you get $28-odd billion, which is more than the total fees paid to all financial advisors in the USA every year. So let me just get that. Investors taking these two bets, one fund manager and one play, largely unadvised investors, have destroyed more wealth than was paid to every financial advisor in the US every year. Total fees are about $30 billion in the US. A disaster by any measure. So worrying about 5 basis points in fees on an ETF pales into insignificance compared to these sort of outcomes. And finally, the third area of wealth destruction is mistiming a geographic play. And the big culprits here are, again, US funds, the RSX VanEck Russia Fund, which is currently delisted for obvious reasons. But VanEck is generously waiving their management fee while someone works out what to do with the underlying shares, which are now obviously subject to sanctions against the US. This one's toasted $2.5 billion. Something a little bit more mainstream is the China iShares large cap. It's called FXI in the US or IZZ in Australia. The US one, again, is toasted $3.7 billion. Or you can combine these two trends and take a KWEB, the China Internet Fund. This delivered a 2.5 times return in 2021, but is now trading close to its 2016 price. That's almost a decade ago. And that one's toasted $5.9 billion. Now, Australia hasn't seen this level of ETF slop, and investors have been slower to pile in. So kudos to Australia here. When I look at the thematic market, there's really only 7 ETFs in Australia that account for most of the money, and it only totals $4.8 billion. So these are the names you might be familiar with. Yeah, there's FANG, HACK, ACDC, SEMI and TECH, and 2 robotic funds, RBTZ and Robo. There's a further $1.4 billion invested in a healthcare fund, IXJ. But of course, add all this up, it's fairly modest compared to the total ETFs on the market of about $320 billion. But looking at the results, only FANG and SEMI have outperformed the S&P 500 since their launch. That's hardly surprising in many ways, given that much of the S&P 500 performance has been driven by the FANG stock, and SEMI includes NVIDIA. So those two have been winners for investors who double down on their allocation to these funds in the S&P 500 or NASDAQ and went all in on tech. It's worked, but hindsight's a beautiful thing. Australia's also largely escaped the US avalanche of covered call funds, with Australians allocating just $45 million to covered calls on the S&P 500 and NASDAQ. Covered calls, there's a recent academic paper I read which called them a devil's bargain. The theory here is that you hold a stock and then you write covered calls on it. That is, you sell someone else the right to buy that fund from you at a price, usually marginally higher than today's price. If the price rises through that limit, you have to hand over your shares and you earn the value of selling that call. If your share ends up below that level, you pocket the money and keep your shares. And that's largely a strategy of trying to generate income from an asset that you hold above and beyond the dividends, which sounds attractive and can work in a sideways moving market. So if the market moves sideways, it is a way of picking up extra income. And but it doesn't work in a generally upward trendy market, which markets do over time. So what you're in effect doing is you're keeping all the downside risk and capping your upside risk. That is never a recipe for success. But it can work, particularly for low tax rate payers in a sideways moving market. And that's not a market we've been in for the last 15 years. So core and satellite, pulling all that together, is really a compromise that tries to have it both ways, but ends up with the worst of both worlds more often than the best of both. And for that reason, we think that this is a bad move. That if you want to play this game, use a core professionally managed portfolio and play with the satellites yourself. If you want to have fun, have fun. But if you think you're adding value ahead of time, you are generally sadly mistaken. I'm Vince Scully, Portfolio Management at Life Sherpa Invest, and this is investing. If you'd like to find out more about how we apply these insights and many others to deliver evidence-based portfolios, head over to lifesherpa.com.au/invest. And that's it for this episode. Till next time, bye for now.
Thank you for listening to This is Investing. Any advice is general financial advice and does not consider your objectives, financial situation, or needs. You should consider whether the advice is appropriate for you before acting. Always read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs before buying any financial product. Vince Scully is a representative, and Simo Interactive, Pty Ltd, and Glenn James are authorised representatives of Money Sherpa Proprietary Limited, which holds Financial Services Licence 451289. And if you want further investing fun, the Quick Start Guide to Investing, as endorsed by Vince, obviously, is available wherever good books are sold, or there's a link in the show notes to get your copy today.